Cool. All right. Now we're good. So again, today's class is going to be talking about working with investment basics. We're going to talk about working with investment properties as if you were going to buy them on your own so that you understand when working with investors what that looks like. So we'll talk about both different types of investors and different types of investment properties. Now, understand there's several different schools of thought to different types of investment properties. There's several different avenues and ways to do it. Today is just going to be some basic information. It's a lot, but it's basic information because the whole world of investment properties is just, well, it's a lot of cool stuff. So why do people buy investment properties? Well, you probably heard the term mailbox money. Mailbox money is just monthly cash flow that creates income beyond your day job. You get a check every month for someone living in a property that you own. Long-term wealth, appreciation plus the rent growth plus paying down the loan over time. Just grows your wealth, right? Retirement strategy. So a lot of folks, they buy them for income for later years to be used as a retirement strategy. So when they retire, they have supplemental income. You combine that in with a long-term wealth, you can see how that can be very advantageous to you as you get older. Some people use it to park cash. For some of us, it's kind of hard to believe that, but they want to put idle cash to work and protect it from inflation. So instead of putting it in stocks and bonds or just letting it sit in the bank, they park it into a property. Most investors, they're not chasing houses. They're chasing quick cash, freedom, stability, and control. Real estate just happens to be the vehicle for them to do that. So what we're going to talk about today is we're going to go over some terminology. We're going to talk about what a buy box is. Anybody know what a buy box is? No? We'll talk about what that is. We're going to talk about the difference between cash flow investors, flippers, and an ROI investor. We're going to look at some basic deal math. I know a lot of you don't like math, so I broke it down really easy today to where you all can work with it. We'll talk about what to ask investors, and then we're going to talk a little bit about where to find investment properties. So you're kind of getting a whole gamut today, right? Good stuff. So let's dive into terminology. You've probably heard the term ARV. A lot of investors like to use that. In our world, that's a CMA. They want to know what the after repair value is going to be. Once I fix it up, what's it going to sell for? Basically, when I fix it up, what's a CMA look like? So if you hear ARV, that's after repair value. Buy box. A buy box is a criteria that an investor uses to decide whether to purchase a property. It includes price, location, property type, condition, the minimum cash flow or the ROI, and then the exit strategy, how to get out of it. I'm going to get into all these. I just want to give you some basic terminology. So as we're talking about it, some of these terms you've at least have heard before. ROI, return on investment, that's basically how much money you're going to make. The percent return based on the actual cash invested, not the purchase price. A flipper, what is that? That's just an investor who purchases a property, renovates it, and sells it for a profit.
So a flipper is the one who would be more interested in ARV?
Yes. Yeah. Flippers are usually the ones that ask, what's the ARV? What's the ARV? Those are the ones you're really going to hear that from. Long-term hold renters or investors normally don't ask that. Equity. Equity is the difference between the property's current market value and the total mortgage balance owed. What it means is, let's say the property's worth $300,000 and I only owe $200,000. I have $100,000 in equity in the house. So how much cash I have that the house is worth over what I owe. Appreciation. It's an increase in the property's value over time, either through market conditions or improvements. So as you know, our market has increased, I think, a little over 5% last year, and I think the 6% year before. So we see appreciation every year. The property values go up. which means the house is worth more, which is great for an investor. Negative cash flow. What that is when a property costs more to own and operate than it produces an income on a monthly or annual basis. This quick little example is your monthly mortgage is $1,600 a month and you're renting it for $1,400 a month. You're losing $200 a month. That's a negative cash flow. You're going to hear some seasoned investors or even new investors talk about BRRRR method. That's the BRR. BRRRR, buy, rehab, rent, refinance, and repeat. It's an investment strategy that we'll talk a little bit more about. But basically, they're just taking their money and they're recycling it to buy more properties. You'll hear the term DSCR. That stands for debt service coverage ratio. It is a type of loan. It's pretty popular for investors. It's a loan where they actually don't look at your documents, any of your finances. The property is qualified based on what the rental income is. We'll talk more about that a little bit later. Cash flow. This is the income remaining after all expenses are paid, including mortgage, taxes, insurance, maintenance, everything. So that's how much money I'm making. Net operating income. That's the annual rental income minus any expenses. So basically, what did I actually make? After all my expenses for the year, what did I make? The cap rate. So it stands for capitalization rate. And what it is, it's a net operating income divided by the purchase price. It's used to compare properties without financing. You're going to see cap rates on mostly your commercial properties. And when you see cap rates, they're based off of cash purchases. So if you see a cap rate, it's 12%, 8%, whatever it may be, understand that is not a financed property. That is a cash purchase. It's a big difference in the commercial world. So if you're wanting to dip into that, you really, really need to learn. Cash on cash return. You'll see it abbreviated as COC. I don't know why that popped up. It's the annual cash flow divided by the total cash invested. Vacancy rate, the percentage of time a rental property is expected to be vacant. Seasoning period. This is the time that you must own the property before it can be refinanced. Capital expenditures. These are large, they're referred to as CapEx. These are large expenses that you run into, like a new roof, a new HVAC. They're not things you're going to see on an annual basis, but over about 15 years or so, that's when you start seeing those things creep up, and you need to plan for them. Value add. When you hear the term value add, what that means is when you do things to the property that's going to increase its value, like renovations, rent increase, different management, things like that. You'll hear of investors talking about exit strategy. An exit strategy is when an investor plans for how and when they're going to realize or they're going to basically sell off the property to make their money. And then you probably hear the terms 1031 exchange. What a 1031 exchange is, it's an IRS tax deferred strategy, and it's allowing investors to reinvest all the proceeds they get from that property into another property without having to pay capital gains tax.
Can we add one more caveat to that, Al?
Sure.
You can also do a reverse 1031 if somebody has cash but has a property that they want to sell. They can still participate in a 1031. The reverse, I did it last year on a beach house. They had to sell one. They wanted to use that money, but they found one that they wanted to buy straight away. So you still get the intermediary. You pay for the new house, but you have all the paperwork together, and then you can still benefit from the 1031. So just know it's a little bit more complicated, but it is available if somebody has the cash, but still has an asset to sell.
Gotcha. 1031 exchanges is a whole different world. I don't want to get into the weeds. We're not even going to get into the weeds of that today. That's a whole other class, but thank you, Jenna, for that input.
If anybody runs across it, they can call you or me because I have done a couple.
Absolutely. So what is a good investment? A good investment is one that matches the investor's goal, which basically fits their buy box. It survives real-world expenses, still works when the market slows. What your role as an agent is to find out what type of investor they are, or you are, discuss and know their or your buy box, and stick to it. That's where investors mess up. And we're going to talk a lot about that. Understand if the property falls into the buy box, do the numbers work? And then mainly, you got to know the numbers. So what is a buy box? Again, it's a set of criteria the property must meet before you or they will consider purchasing it. What it typically includes is what their price range is, the location, the market they want to buy, the type of property they want to buy, a single family, a duplex, multifamily, manufactured home, that kind of thing. The condition of the property. Is it ready to go? Turnkey. I don't want to have to make any repairs. I don't want to do anything. Does it need just a little bit of repairs, some paint, light rehab, or do I need to like gut the thing or heavy rehab? What's their investment goal? Is it cash flow? Is it ROI? Is it appreciation? You need to know that. What's the minimum performance? Is it the cash flow? Is it the ROI? Is it the cap rate? Or is it the cash on cash return? We're going to talk more about those a little bit later. What is their hold strategy? Is it a long-term rental? Is it a short-term rental? Is it a flip? Are they going to burr it? We need to know all that. You need to know all that when you're looking to get investments. And then finally, what's your exit strategy? Are you going to sell it right away? Are you going to hold it for 20 years? Are you going to refinance it? Do you want to keep it and do a 1031 exchange later? What is your plan? So an example of a buy box is, let's say, price point of $120,000. I've got $50,000 cash on hand. I want the property to be 30 minutes from base. That's my demographic. I'm looking for a duplex or a townhouse. I'm okay with a light remodel. I don't want to have to do a lot of work. I want it to cash flow at least $200 a month in a slow market. And it's going to be a long-term hold for retirement. That's a sample of a buy box. Right? Any questions? Everybody good? Now that's going to vary depending on anybody. But if you're looking to do investment properties and you're talking to an investor, they need to figure this out. You need to figure this out. So that sets your guardrails so that where when you're looking at a property, you know what you're looking at. Does it fit it or not? So there's different types of investors. The first we're going to talk about is a cash flow investor. They hold the property. What their goal is that their monthly income, and they want monthly income and stability. They want positive cash flow. They often buy single family rentals or duplexes, some small multifamily properties. What they care about is a monthly payment, rent minus expenses, vacancy, and maintenance risk. They usually hold them for a long time, and they think in monthly dollars. So if we look at the deal math to the right on a basic cash flow investment, if they buy a property at $180,000 and they put down $36,000, that's 20% down. Then look at their monthly expenses. We know their interest rate, their mortgage, we're going to assume is $1,250. We're going to assume a vacancy rate is typically 1%, by the way. It's 10%, which is like 1 month. So if they're calculating and thinking about vacancy and you're looking in like the annual income of that property, you subtract 1 month's rent, and that's what you can predict what your annual income would be. Maintenance is also usually about the same. My number's a little low. Property management is typically 10%. It varies for management companies, but it's 10% of the rent. So if we look at our total expenses, adding all that up on what we think it'll rent for at $1,600 a month, our total expenses are $1,460 a month, which means the property cash flows $160 a month. Does that fit our buy box? that we talked about a minute ago? No, our buy box previously was $200 a month. It's not in our buy box, is it? And then we got to remember these rent rates, that estimated rent is on today's market. A lot of investors look at today's market and say, well, I'm making a couple $100 a month. That's great, right? But you got to think about slow markets. We're going to talk a little bit more about that as we go. Everybody good so far? Everybody online good? Again, I can't see you all, so if you have a question, please speak up. Let's talk a little bit about a flipper and what they look at. Their goal is a return on investment. They want to make money quickly. Flippers are investors who buy properties below market value, renovate them, and sell quickly for a profit rather than holding them as rentals. They focus on the purchase price, the rehab cost, the timeline to rehab the property, the ARV, what the home will be worth once it's rehabbed, the short-term market conditions, meaning what direction is the market going, up or down. That's when you come into play. I know you all hear me talk about watching the hot sheet, keeping on top of the market and the numbers. We talk about that in our office meeting. I send out stats all the time. This is how you can watch market conditions. When you see a lot of price changes in the MLS, what's that tell you? If their price changes coming down, that's right. But if you see price changes going up, that tells you prices are going up. If we see where sellers are giving less closing costs, that's also telling you values are going up, right? So that's where you understand market conditions. As an agent, if I'm going to buy a house today and somebody comes to me and says, what can I sell this for in 6 months? Can you predict that? Not really, unless you understand the market conditions and what's going on, right? And who do they rely on? You. So let's look at an example for a flipper. Let's say the purchase price of the property was $150,000 and only cost $30,000 to rehab. And I'm using very generic numbers because there's other things we need to consider that we'll talk about a little bit later, like holding costs and things like that. So the total they have invested, we'll say, is $180,000. The after repair value, or ARV, is $230,000 once they fix it all up. Their selling costs, meaning agent fees, closing costs, holding fees. Holding fees are whatever they're paying for the mortgage, the utilities, the insurance, the maintenance, the long maintenance, electric bills, everything else. We're just going to say it's $20,000, which is low. So the net sale proceeds, if $230,000 minus $20,000 from all the selling costs, means they made $210 on the sale. What they profited, we take the $210 minus the money they have into it, $180,000. They profited $30,000 on that property. Some investors, that's good. Some investors, that's bad. We'll talk about those questions you need to ask an investor a little bit later on. Make sense? Simple math, right? I told you, I'm not trying to show you a ton of spreadsheets or everything. I just want you to understand some good fundamentals. So when an investor comes, you understand what to ask them and what you're looking for. So let's talk about an ROI investor. These are pretty crazy. This is another one that holds the property. Their goal is to park the money and grow wealth, leverage the property later, and they're focused mainly on equity. They're okay to accept breaking even every month after it's rents. They don't care about making a profit every month. They're just putting their money in it. Some are even okay with a negative cash flow. Remember what negative cash flow is? Anybody? Every month I'm losing money, $100, whatever, right? Costs more to whatever my mortgage is more than what I'm making for rent. They're often buying places that have appreciation markets, meaning values going up in the markets consistently. They can do some value add to the property. They can improve it, add a few things to where it increases value. And some are even looking for BRRRR deals. not really often for the long-term ROI investors. They're more into hold on to it for several years, 4 or 5 years, and then get out. What they care about is the equity gain, which means growing money on, as the property grows in value. We have more money in the property. Rent growth, meaning rent prices go up. Being able to refinance it at a later date to bring down their payment so they can make more. And then what their exit strategy looks like. Is that they're going to do a 1031? What are they going to do? They think in percentages, in timelines. So let's look at the example. An investor buys a home for $200,000. They put $40,000 down. That's 20%. The property breaks even each month. There is no cash flow from the mortgage to what they're renting it for. 5 years later, the home is now worth $260,000. That's assuming a little over 5% increase each year, which is about what we've seen, right, in our market. The mortgage balance is only $145,000. They've paid it down. So they have about $115,000 in equity based off of those numbers. The original cash they invested is only $40,000. So when they go to sell it, they make $75,000. If you divide that by the $40,000 that they invested, that's 187% return on investment. Now that looks really, really good, doesn't it? But understand, this example often misses the mark because it relies heavily on appreciation. It doesn't fully account for the unknown or variable expenses such as vacancies, bless you, maintenance, insurance, and tax increases or management costs. It doesn't matter because they don't care about that. Remember, they don't care if it's breaking even. They're not looking at cash flow. They're looking at what am I going to make? Yeah, bless you again. They're looking at the long term. When I go to sell, how much am I going to make when I sell? I can carry it till then. I'm not worried about those costs. When I sell, what's it going to make? And they're relying on this piece, this appreciation, the 5.4% increase every year. And they're also not considering any large prices, large vacancies, if the market changes, things like that. So this is typically somebody that has a lot of cash, a hedge fund, things like that. They just want to park their cash and they don't really care about taking a loss, and it's for tax purposes. Everybody online good? Cool. No news is good news. We're going to assume no news is good news. So let's break down the steps on holding the property. Let me check the chat real quick. Good. Thanks, Jenny. So holding the property, financing. Before anything else, the deal has to survive the payment, which means we got to make sure we get a good purchase price. And then we got to understand, how's it going to be purchased? Is it going to be cash? Are they financing? What kind of down payment, interest rate, loan terms, things like that? Are they using creative financing? Are they using hard money, a DSCR loan, a private loan? If finance, what's the monthly payment? We need to know that for the deal, right? Step 2, what's it going to rent for? So let's test the income realistically. Today's market rent amount, meaning look at the MLS, don't look on Zillow. And then look at a conservative rent income estimate, meaning today's market is renting at $1,600. I may look back a few months and see what they rented for a few months ago, or even 6 months ago, to see if it's come up or came down, so I can get a good conservative idea. Then ask, what would this rent for in a slow market? And if you look at the tip over to the right, it says, look at the MLS about 10 years ago and see what the homes rented for then. That'll give you a good idea about what it rented for in a slow market, right? I don't know, for those of you that don't understand or never researched the market as far as history goes, markets cycle about every 12 to 15 years. And what I mean by that is from the time it's at peak to the time it's low to the time it's back at peak again. It takes that long. About 10 years for it to be low, about another 10 years for it to come back high. So we're in a high market. Our last low market was about 2014. Last high market before that was about 2007. So you see our history, right? That's why I put in 10 years. So let's look at the deal math. Basic purchase price 180, down payment 36,000, financed 144,000. So we're going to assume the monthly payment is 1,250. We're going to assume today's rent is 1,600. That's a good margin, right? But when you look at the slow market rent, it's only 1,200. Does that fit my buy box? For today's market, it does. Today's market, if our today's rent is 1,600 and our monthly payment is 1,250, we're making what? 350 a month. That's really good. But if the market shifts and it goes to 1,200 a month, we're losing 50 bucks a month. But now it's a conversation. How long do you plan on having the property? Can you save the money so that when those slow months come, or be able to manage that by maybe a refinance or doing value adds to bring the property up? See how all that plays into it? Does that make sense? Everybody tracking?
Hi.
Hi.
Hello.
So let's look at another one. Continue on holding the property. Let's look at expense reality. So income without expense isn't real, meaning we looked at how much we're going to make, but we didn't calculate any of the expenses. Those expenses normally include property management. Even if you self-manage, you have to put in a value for your time. And for tax purposes, I highly suggest that you charge yourself. But anyway, vacancy typically predict about 5 to 10%. Maintenance and CapEx. You need to take some money and set it aside each month for maintenance or for capital expenditures. This is important when you first walk through the property. If you see that the roof looks like it's going to need replaced in 5 years, we need to start saving. If it's got an old HVAC, we either need to be planning for an HVAC or we need to have a home warranty on that property. You can get a basic home warranty that'll cover the HVAC for like $550. Insurance costs, have they gone up over the last several years? Yes. So we need to be thinking about that. Same with property taxes. Are they going up this year? We don't know. It's a new evaluation period. I will be talking more about that later on. And then if there's an HOA, what are the fees for that? So the formula is the net rent, the $1,650, minus all the expenses, and that equals truth. Is it going to make money or not? Make sense? Mm-hmm. Step 4. Is it a cash flow or is it ROI? So we need to know what the investor's goal is. Do they want cash flow or do they just want the growth? They want the long-term exit strategy growth. Make sense? Let's do another example. Purchase price 180, same thing, down payment 36. Our monthly expenses, $1,250 for the mortgage, for the payment, principal, interest, taxes, and insurance. Vacancy and maintenance, we're assuming 150. We talked about the same sample earlier. Management fee 160 comes out to a total monthly expense of 1,560. Today's monthly rent 1,600. They're making 40 bucks a month, positive cash flow. Does that fit the buy box? What was our buy box? How much? 200 a month. We are way off that buy box. We need to move on, look for another one. Make sense? I don't care how much you love the property, how much they love the property. If the numbers don't work, move on. Let's break things down for working with a flipper. Step 1, you got to find the right property. Flippers are looking for properties priced way below market value. Is a flipper only looking for cosmetic repairs? Or are they okay with a moderate or a large rehab? Not a structural nightmare. Maybe they're okay with that. They want to know that it's got a strong resale demand in that area. So if somebody was buying something in, let's say, I don't know, Beulahville versus Sneads Ferry, which is a hotter market. Sneads Ferry. Beulahville is a lot more riskier, right? It's further out. Not really.
Nothing wrong with Beulahville.
There's nothing wrong with your new construction in Beulahville, Jenna. I'm not saying
Thank
that.
you. We
You're
sold
welcome.
2 yesterday.
Congratulations. Just understand that Beulahville may sit on the market longer than Sneads Ferry. Flips are made on the buy, not the sell. You got to buy them right. Run the numbers backwards. What do I mean by that? Start with the end in mind. I'm going to sell it for $400,000. My after repair value, $400,000. My selling and holding costs, what that's going to be. Let's say it's $40,000 minus my renovation budget. My budget is $50,000 minus what I want to make. I want to make $50,000. So that's $140,000, and I'm selling it for $4. I need to get that property for what, $260 or less, right? That's how you figure out, is it a good deal? That's just basic math of running the numbers to figure out the deal works. Obviously, we need to look at more of the little details of that, but that basically breaks it down. And then you need to know the exit. Before making an offer, confirm the resale comps, confirm the buyer and market demand, meaning what do I think it's going to look like in a few months? Because we're taking a chance. I've done a lot of flips. I have a lot of rental properties. I've got into some where the market shifted to the point, if it didn't shift, I'd have lost my ass. And I was very thankful because we ran into a lot more repairs than we thought. Lose contractors, fire GCs, and it can delay the process. I had one that took over a year because of that. So, and when you plan on 3 to 4 months and it takes 14 months because of that and permitting, you could easily lose your ass. So you got to be thinking about that kind of thing. Know your price point on the way out and know the timeline it's going to take to rehab and get it back in the market. We'll talk a little bit more about that stuff in a minute. They got to rehab with discipline if you're flipping. You got to stick to the scope of work. You got to control the timelines, meaning you need to know what contractors you have going what time to do what work, and you got to make sure they're showing up. Because if they're not showing up, the work's not getting done. And that happens a lot. They're all gung-ho at the beginning. They take a deposit, and they do that to 5 or 6 other people they're working with, and they're trying to leverage their time between 5 or 6 projects instead of focusing on yours. So it's very, very important you pick your contractor wisely. Avoid one more upgrade syndrome, meaning, man, if this had granite countertops, it's going to cost me another $1,500. Is that built into your budget? Or I'd rather have that higher end LVP. Yeah, well, I am going to flip it and it's going to sell. Does it look good? Will it hold up? Let's just stick with that. See what I mean? Time is money in a flip. We got to get it done. We got to get it back in the market. And we got to get it gone. Price and list strategically. So when you're pricing a flip, here's where a lot of investors mess up. They get it back in the market and they want to price it top end. Some investors are successful with this. It works well for them. Typically, when you price it on high end, what happens? Sits on the market longer, right? Which means they have holdover fees. Holder fees are costs for having the money. There's fees for taking out the loan. Each month you got to make a monthly payment, right? Not to mention maintenance, not to mention potential vandalism and break-ins. That happens a lot more than you think.
Does insurance cover that type of stuff?
Nope. Utilities, yep, all of it. Lawn maintenance, everything. Cleaning it again because everybody's been in and out of it. Normally, you'd want to wait until it's almost finished so you get strong photos for presentation. Have you ever worked with a buyer that just can't see how that's going to look when it's done and they're concerned because they see a complete disaster right now? So you take photos of the house and you put it on the market and you have buyers walk through and you price it at top end, but they can't visualize what it's going to look like. Wait till they can visualize that before you put it on the market. It's all about presentation. Step 6, close that sucker out. Close it fast. And then recycle the money into another deal, and let's repeat that process. That's basically a BRRRR method. Well, that's not a BRRRR method. That's just a flip method. Let's buy it, flip it, sell it. Let's go do another one. Make sense? Flippers don't fall in love with a house. They fall in love with the margins. When you fall in love with a house and say, I love it, I can make this could be so cool when it's done, but the numbers don't work, you messed up. So I don't care how cute that little cottage house could be after you're done remodeling it and all the little cute little foo-foos and how you can make it look so cool with new windows. Just understand that those margins don't work. I hope you love it that much to where you're willing to take a loss. Yes, sir.
So you basically take this and break it down and go backwards, work backwards.
That's right.
So what, let's say, I have a client having the house flip, you could work it backwards to where you can see what their margins are.
Mm-hmm.
Basically.
So when you,
With all the holdings.
that's right. So what Ethan asked was, I have someone looking at a property that's been flipped, right? And we're trying to figure out what they've got into it to see what their margins are. Yeah, you can do that. The risk, you don't really know how bad the property was when they bought it. You just know what they bought it for. And you don't know what kind of financing or what they've got as far as holdover fees. So there's a lot of assumables when you do that. Just know that.
Around here, you can kind of figure it out.
Same. It's the same. I'm telling you. Yeah. So let's talk about typical financing types by investment strategy. So if we look at hard money, what hard money is, it's an investor that doesn't really go off of any government regulations. It's a group of individuals that have cash. They lend money out for short periods of time, 6 months, 12 months, right? Hard money is typically used for short-term financing for flips, for BRRRRs, because they're going to buy it, they're going to rehab it, they're going to rent it, and then they're going to refinance it. So they get the cash back to the hard money company. Some things to look out for whenever are good things with, we'll look at the bads in a minute. So why people use hard money is they're fast closing, they close quick. The approval is based on the property, not the borrower. So they don't really care about your finances. They want to make sure that the numbers work. What are you buying it for? What's the rehab cost going to be? What are we going to make at the end? What are you going to make at the end to make sure we get our money back? That's what a hard money looks at. They don't care even about your credit score. They care more about your experience doing flips than they do about the rest of it. Your experience and what the return is going to be. That's what they're concerned with hard money. And their fees, we'll talk about that in a second. DSCR loans, debt service loans. They can be used for long-term rentals because they usually have a prepayment penalty. We'll talk about that. They're based off of the property income. That's what qualifies them for the loan. Again, they don't care about your finances. They need to have 20% down, but they don't care much about anything else. Your debt to income, they don't care about all that. It's based solely on the property. Conventional loans, they're used basically if an investor is only having a few rental properties. The rates are usually lower than the DSCR and hard money. That's typically for longer terms, and they based off the borrower's finances. So now we get into, instead of the property, it's the borrower, right? It's you. They're looking at your finances instead of what the property is going to do. Portfolio loans, that gets into folks that do lots of properties. They'll take 4 or 5 properties and they put them into like an LLC, and then they take one loan out for all those properties. It's complex deals. There are flexible guidelines for that. It's based off the property and the borrower. It's more off the property. They just usually want to make sure that the borrower has what's called cash reserves, meaning if my monthly payment is $3,000 a month for all these properties, I need to have 6 months of that in a bank. I need to have at least $18,000 in an account to cover my 6 months. Does that make sense? Private money. Private money is a great way. Private money is people that you know, friends, family, people like that have money that they don't want to put in the stock market, but they want to invest it somewhere. They can be good for flips. They can be good for what's called gap funding. Gap funding is when I'm going to borrow the money from you for about 6 months or 12 months. I'll have an interest rate. You'll get a return. All that's agreed upon up front. And then I'm going to refinance it in about 8 or 9 months and give you your money back.
Is that the same?
Yeah. Same thing as bridge money. As far as gap funding goes, yes. There's a lot more flexible terms, and usually you can close a heck of a lot faster because you don't really have appraisals and things like that. And then cash works for any strategy, and you have strong negotiating power with that. Everybody good so far? Anybody have questions online? Sweet. So let's look at the flips versus hold and what the best type of financing would be for each one. For flips, you're typically going to see them doing cash, hard money, private money, or what's called bridge loans, gap loans, that kind of thing. If you're doing cash flow rentals, those are usually DSCR loans. They're conventional loans or portfolio loans. If you're looking for ROI or appreciation rentals, those are also can be conventional, portfolio, or DSCR. BRRRR strategy, hard money. That can be converted to a DSCR, and it can also be converted into a conventional loan. Your BRRRR strategy, you could also use private money for that, would be another good one. Again, the loan should match the timeline, not just the rate. A lot of times, people get so stuck on what their interest rate is, right? I'm paying a 10% interest rate or a 12% interest rate on hard money. If I calculate that into my finances for my plan, right, and I'm still making a profit at the end, I don't care. I'm not using my money. It's all calculated in, right? What to watch for in each finance type. Hard money. Hard money has a lot of what's called points. Everybody know what points are? Points is what you're charged to use the money. So if I borrow $200,000 and they're charging me 2 points, they're charging me $4,000. 1 point is 1% of the loan amount. There usually is several points. There's usually 2 to 3. I've seen 4 points on hard money. Their interest rates are usually higher. I've seen them as high as 15, 16%. Their loan terms are short. They're usually 6 months. Sometimes you can do 12 months. And then they have processing fees. They also have prepayment penalty fees, meaning if I pay it off in 3 months, I may get penalized. They have fees if you go past that timeline. I borrow the money for 6 months and I don't get the flip done. So now I have to extend the loan. They're going to charge me for that. So need to understand the terms if you're doing hard money. DSCR loans. They typically base it off of about a 1.2% ratio. And what I mean by that, well, let's say that the mortgage on the property is $1,200 a month. And the rent is $1,450. That qualifies for a DSCR loan. Because the rent is over 1.2% of what the mortgage is.
So can it?
Yes.
So if we're in the MLS, we see a house that piques our interest, it's for sale, and we don't have necessarily 20% down.
Got to have the 20% down.
Okay.
You got to have the down payment.
Okay.
Yeah, the DSCR, there's no way around that. But if you have the down payment, but you say you have a poor credit score or you have a lot of other debt that you're paying off, If you have the 20% down, you can still use a DSCR loan because they don't look at that stuff. The property. That's right. I've seen that as low as 98%. Yep. Actually, I'm sorry. I've seen it as low as 95%. So some things to watch for is what their minimum rate is. Is it 1.2? Is it 1.4 for what their ratio? Make sure what they're using for rent calculation methods to figure that out. On DSCR loans, there's usually a prepayment penalty, meaning they're going to charge you, say, an 8% rate, and your plan is to refinance it in a year and a half, but they're usually want you locked in for 3 years, and you're going to pay a penalty if you refinance it before then. They usually have points, they usually have fees, and their loan terms are usually not as favorable as like a conventional loan. They're usually built off of, there's a lot of different ways. They could be a 20-year amortization with renewing every 5 years based on market conditions. You know, a DSCR loan is to get you into the property to where you could be making money each month, and your goal is in a few years refinance it and get it out of that to drop the rate down, or sell it because of appreciation, but you're still got cash flow. Make sense? Conventional loans, things to look out for. It's got to have an appraisal done. So if it needs a lot of work, it may not work for that, right? For the property you want to buy. Condition requirements. And then they do look at your debt to income. There are limits for debt to income when it comes to conventional loans. Portfolio loans, they usually have what's called balloon payments and adjustable rates. Does everybody know what I mean by balloon payments? Because I don't think I had that in my definitions. A balloon payment would be, for those that don't know, is I'm going to buy a property, and typically when you mortgage a home, you mortgage it for 30 years, which means that the payment is spread out for 30 years or amortized over 30 years. So my payment is based off of a 30-year loan. However, they want all that money paid back that I borrowed in 10 years. So I have a loan that is amortized over 30 years. But that balloon is due in 10 years, which means in 10 years, I either need to refinance it, I need to sell it, or I need to pay it off. Which is great to get you in a property if you can get the terms right. Private money. There's usually exit expectations. A lot of your private money folks don't want to tie their money up for 20, 30 years. Hence the balloon payment we just talked about. It works great with private money. That's what I mean by repayment terms. How long, how much, how quick can I get my money back? Anybody ever run an amortization schedule or look at an amortization schedule whenever you buy a house, right? If I'm making a payment of $1,000 a month just towards the mortgage, how much of that is interest, do you think? Each month. If my monthly payment is $1,000 a month, just for my mortgage and interest, the money I borrowed and the interest I'm paying on the money, how much each month in the beginning do you think that goes towards just the interest? About 80% of that, about $800. So you can use that to show a private funder, family, friends, look, in 5 years, this is how much interest you're going to make. They make all their money in the first 10 years, right? See how you can tie all that together? I don't want to get too deep into math, but just telling you there's a lot of different ways out there to make deals work. Cash. The problem with cash is your liquidity risk, meaning I have all my cash tied up. I need it for something else because something happened. But you have a refinance plan. I can buy it for cash, and then I could go and put a loan on it. I want to take money out of the property and just put a mortgage on it. Right? HELOC. How many of you bought your house probably, I don't know, 5, 6 years ago? And if you have about $100,000 in equity, you could do a HELOC, which is a home equity line of credit. What that allows you to do is there's two different types of HELOCs. By the way, at the end of this, I have about a 4-page guide on different types of financing, and it breaks it all down on different criteria for each. It talks about the benefits, the pros, the risks, the cons, and it has examples. And I'll hand that out. And yes, I'll email that out with the slide deck so everybody can have a copy of that as well. But what a HELOC is, there's two types of HELOCs. If anybody ever did it, you're basically taking a second loan out on your home. You can take that out as one lump sum. I have $100,000 in equity in my house. They're not going to give you all $100,000, but let's say they give you $80,000. You could take that out as one lump sum and then just make payments back to that. Those terms are usually 10 years to get it back or 20 years to get it back. You can also do a HELOC where it's like a line of credit, hence the home equity line of credit. That is where you take out, let's say, the $80,000, but the cash doesn't come out of that account. You're not making any payments on it until you take the money out. So it's just sitting there for you to use and find the deal. I find a deal, I take out $60,000 out of that HELOC, right? I'm making payments on a $60,000 HELOC till I get out of the property to pay it back. When I make maybe my monthly payment, maybe $600 a month. And then when I pay that $60,000 back, I can do it again because that HELOC stays in place for 10 or 20 years. Most banks are 10 years, meaning you have 10 years to use the money or pay it back. Other Navy Fed has a 20-year HELOC. 10 years to use it, 10 years to pay it back. And when you amortize $80,000, your monthly payment's like $680 or something like that. So you're only paying $680. It's interest-only payments, but you only need the money for, what, a year or two? The renter is going to pay that till you can refinance it and get, hello, you get into a property? Anyway, use your money. Let your money work for you. If you don't understand that, come see me. I'll get more in the weeds with that and help you understand it. But if you have equity in your home and you want to buy investment property, if you haven't seen this today, you can make it work.
Do people, I know the answer, I'm just asking for others. Do you have to qualify for a HELOC or an equity line or equity loans from your home?
So the question is, do you have to qualify for a HELOC? Yes. They do look at your income, but they're mainly looking at the property, your payment history, right? And there's a property value there. That's what they're mainly looking at. Another great option is seller financing. In seller financing, again, there's balloon dates probably. The main thing with seller financing is the title position. What I mean by that is sometimes sellers will do owner financing or seller financing, but they want the property in their name. Same with owner financing. In other words, I'm going to buy a property, but the property is going to stay in the seller's name until I pay them off or hit a certain criteria where we could transfer the property into my name. I would not do that. I want the property in my name, and we'll do what's called a promissory note that says, I will make the payments to you or you can take the property back, right? Very important if you're doing any type of seller financing or owner financing that the property, it goes into your name. And again, the loan should match the timeline, not just the rate. I'm not worried. I wouldn't be worried about the interest rate if the deal works. Again, it's getting in the door, right? And the numbers work. Because if the numbers work going in and you have cash flow or your exit strategy works, do you care about that? No. It's like saying, I'm going to pick this floor for $1,400 or $14,000 because that one is $15,000. But that one, other floor that's $15,000 is going to help me sell quicker. See what I mean? Does it matter at the end? Because I have that money put into my budget. Make sense? Everybody online still good? What kills a deal? This kills a deal across any type of financing. Payment doesn't cash flow. or doesn't fit the ROI plan, meaning my payment is just way too high. The rent doesn't support the DSCR requirements. I'm inflating the rent today. You know, I'm showing them numbers that says the rent's going to be this high when it's really not. The rehab costs are underestimated. So when I went out and looked at the property, I thought it was going to be able to only be 30,000, ended up being 60. I can kill it really quick when we only had a 30,000 profit margin earlier, right? The appraisal comes in low, normally for the buy side. In other words, I didn't do my CMA. I didn't do my ARV very well. I didn't forecast very well. I don't have a clear exit strategy. I don't know how I'm going to get out of this. I just know that I'm going to buy it and I'm going to flip it, and then we'll figure out how we're going to get rid of it. The timeline doesn't match the loan term. I took out a hard money loan. I have 6 months to pay it back. It's going to take me 5 months to rehab it. Well, how long does it take homes to sell today? 60 days. We're already over that timeline. Points, fees, prepayment, or extension penalties are ignored. Look, I can get this loan for this amount. I'm good to go. But there's $15,000 or $17,000 or $20,000 into using that money because I paid it off early, or because of monthly payments, because you normally are paying interest-only payments that don't go towards what you owe, meaning $1,000 a month back to the DSCR company, or not the DSCR, the hard money company, so that they're getting their interest also, which you have to figure into your money, figure into your budget. 6 months at $1,000 a month is $6,000. $200,000 loan, and I paid 2 points. That's $4,000. I got $10,000 just to use the money, and I haven't even talked about other fees. See how that can add up quick? Got to know the numbers. Or the investor's buy box doesn't match the property. I love that cottage house. That's really what I need to get. It doesn't, my numbers don't work, but I'm getting it anyway. That's where you fail. Again, most deals don't fail because of price. They fail because they didn't follow the buy box plan. They didn't calculate the expense and income correctly. The delay in repairs, or the financing doesn't fit the strategy. A comment, something that I live by when I look at properties is I'd rather lose a questionable deal than get a bad one. So if I'm looking at the numbers and they just don't seem to work, I don't care how bad I want it or how much I think it'll work out well, I pass. Look, a bad one could destroy you, right? And I'm not trying to scare you, but you can get properties out there if you just follow your plan, right? Follow your plan. And you can help investors if you just follow your plan. So some things to ask an investor. Before you even show a property, you need to know this type of investor. You need to understand, are they really an investor or not? One of the first things you need to ask, have you done this before? First time versus experienced investors. First time versus experienced investors is a whole different type of guidance. Whole different type of guidance. Are you looking to hold it? Or are you looking to flip it? Obviously, why? Because it determines financing, inspections, timelines, exit strategy, right? Everything we've talked about, but we need to know that. What kind of return do you expect? This is very, very important. Do you want a percentage return, which is based on how much cash they put into it, not the sale price, but how much cash they have invested and what percent of money they're going to make after it's sold? I put $200,000 into it. I'm going to sell it for $3,000. After I sell, I'm going to make $60,000. 60,000 to 200 is whatever the percentage is. Does that meet my 15% margin? Those margins on percentages are usually higher. When I work with investors, I usually try to get them to tell me $1. What's your target profit dollar? Do you want to make $10,000 on a flip, 25 or 50? They're going to say the more the better. Cool. What's your minimum? If they tell you, I just want to make $10,000, that should scare the shit out of you. Why?
Because they're
Why
not
should
going to
that
be able
scare?
to follow it through. They don't have what they need to have. You want 10 grand, go put it in a CD.
Well, if they want to make $10,000 in profit, is there a lot of things that have to happen between the time we get it to the time we sell to make that happen on our projections? Things like, did they fit their budget when they did the rehab? Were their holdover costs too high? What about their finance terms? Did we sell for the right price that we thought we were going to sell for? Did the market go up or stay the same? That margin is too little. It's very risky. Because when you get into doing a flip, $10,000 can go away real quick. And we're going to talk about that in a minute on things to look for. Yeah. Yeah, to sell. How much are you looking to spend total? Purchase, rehab, and holding costs. Well, I'm going to spend $40,000. Okay. What type of loan are you using? Because we already know 20% down on 200, that's 40 grand. We have no money for rehab. Doesn't work, does it? Would this be cash or financed? It's going to be cash. Okay. Well, how much cash do you have? How much cash do you have saved for this project? Oh, I got about $40,000 and I want to use my VA loan. Does that work? No. VA loan, you have to occupy it as your primary residence. But you got to know the numbers. Renovation, product and location, inspection reality, renovation questions. Do you have your own contractor or will you do the work yourself? I'm going to do it all myself. I know how to do all this stuff. Cool. How long does it take you to normally do it? Well, I have a job that I work a day and then I do some night work. So probably just on the weekends. Okay. And how long do you think it's going to take you? Just a few weeks. Gotcha. Long timelines equals higher risk of market shifts and lower margins. If they're self-performing the work, are permits required? Are licensed trades needed? We're going to talk about that here in a couple of slides. That's very, very important. Product and location. What type of property? This goes back into our buy box. Single family home, mobile home, condo. Do you have any specific area preferences? Most investors, they don't really care about the area. They just say, bring me a deal. They just want the money numbers to work. They don't care about zip codes. Inspections. A lot of investors won't want inspections. Some will, but the good ones won't. The new investors, you need to strongly suggest that they get one done. A septic inspection should not be an option for any buyer that you work with, investor or not. A septic inspection should always, always, always be recommended and required. If they don't want to do it, you need to get that in writing. If it has an AC unit that's old, regardless, you're probably going to want to get it inspected to make sure, because that could be a large cost. Home inspections, they're strongly recommended if it's a new investor, if they're doing their own rehab, if it's on a foundation. If you have a seasoned investor that can go out and walk the property and they can tell you everything that needs to be done, they may not need to do an inspection, right? But you need to suggest it, and you need to recommend it. And if they decline it, get it in writing. Send them an email. Look, based on our conversation, I recommended a home inspection. You do not want to get one. Please respond confirming you do not want to get a home inspection. I have it in writing. Where else would you put that at when you write the offer? What other form could you use to put that on? Anybody?
Professional service disclosure.
There you go, Jalen. Hell yeah. That's what I'm talking about. Exactly right. Professional services disclosure. Awesome. So financing strategy and common financing rules. You need to understand the strategy for a hold and a rental. Are they financing the purchase? What cash do they need for the rehab? Because they're going to have to probably rehab it to get it up and running for rent. What kind of time do they need for the rehab? How long is it going to take you to get it rehab before you can get it rented? Are you using the BRRRR strategy? If you are, total amount to be refinanced at the end, meaning I'm going to buy it for $100,000. I'm going to put $20,000 into it, and I'm going to refinance it for $140,000. Why $140,000? Because I just paid myself $20,000 to do it, and the tenant's going to make payments on that. So I made $20K using that method. Make sense? That's how a lot of folks do it for BRRRR. That's the whole purpose of BRRRR. Yeah. Because you're getting paid monthly, but you're also getting paid to get into the deal. Remember, you're buying low. Make sure you understand the expected rent and make sure you understand the monthly cash flow target. Some other common financing rules, things that people run into. Conventional loans, again, they typically are 20% down. The main thing for conventional loans is seller concessions. I've seen a lot of people make offers using conventional loans, asking for $10,000, $15,000 in concessions, and they're not going to get it because the cap is 2%. You know, $200,000, they can only get $4,000, but they want $10,000. At closing, they're going to come back and ask for another concession. As a listing agent, you should know that going into it. It's a concession. Yep. DSCR loans, they're 20% down. And again, they're based on the property performance. The rent must support the payments. Again, often 1.2%. Flips, cash is king for flips. If they have cash, that helps them with timeline. That helps them with fees for using the money, right? It helps them with a lot of things. Hard money, again, watch for the fees. Owner or creative financing, watch out who owns it, who's the title going to be in. And watch FHA seasoning on a purchase. What FHA seasoning is a lot of investors will get in and they'll buy a property, say in the MLS or a foreclosure that's listed. They flip it in like 30 days. They put it back in the market, and the buyer is using a FHA loan, sometimes VA. There are requirements where it has to be 90 days before they resell it, or they're going to want 2 appraisals done. The mortgage company will want the buyer to get 2 appraisals because it was sold too quick. So just know that going into it. Seasoning period. What a seasoning period is, it refers to the minimum amount of time an investor must own a property before it can be refinanced or sold using certain loan types. Many financing options require the property to be held for about 6 months. I think that's actually 210 days, not 180 days, but different programs are different. Most of your standard financing, VA, FHA, it's 210. Some loan programs have longer or stricter rules like we talked about earlier. For DSCR, 3 years before it can be refinanced, so there's payment penalties. So it really depends on how the property was purchased, whether it's refinanced or resold, and the loan type being used. Why it matters? Because the investor's timeline may not match the seasoning requirement. So the exit strategy can fail, even if it looks great on paper. Some critical things to notice on flips. This is huge, folks. When you're working with flips, you need to make sure your investors, contractors are pulling permits. Did you know that in Onslow County, that if you change a simple light fixture to a ceiling fan, like I have one of those little button lights and I want to put a ceiling fan in, technically you need a permit to make sure that the box you're mounting it to is a ceiling fan capable box of holding that weight. Yes, check the code permitting. To hang cabinets, kitchen cabinets on the wall, you got to have a permit. Reason being, they hang them up, they don't look for studs, they put screws in the sheetrock. It's sitting there, people move in, put dishes in, cabinets fall down because there's nothing that the screws are tied into to hold those cabinets on the wall. Got to have a permit. Replacing a hot water heater, got to have a permit. Major structural work, floor joists, piers, things like that, got to get a permit. And you have to use licensed tradesmen. You as a homeowner can make repairs on a home that you're going to live in for a long period of time. But if you're going to take that property and sell it, you cannot. You have to hire people. Licensed trades that are required, HVAC, electrical, plumbing, maybe even a GC. If a GC will be required if the total project cost exceeds $40,000. I'm going to do a rehab at a property that's going to cost me 50 grand. You got to get a GC per code. What?
Can you be your own GC?
Yeah, you can hire your own GC, absolutely. But they have to be a GC, which pulls permits to do the work, which increase your costs. Because you have the GC's margin, you have the permit fees, right? See how that can add up? Substantial renovation rule, 50% rule. This is different in different areas. If the rehab is going to be greater than or equal to 50% of the home's current market value, they're going to require you to bring the whole building up to current code. Meaning plumbing, it's got old pipes, they want them all replaced. Electrical, old wiring, it's all going to be brought to current code. Foundations, did you know in 2012, a foundation piers, Sterling Farms has these homes where the piers, which is the columns underneath the house that hold up the house, they could be spaced 12 foot apart. Today's code is 8. Those piers can cost anywhere from about $800 up per pier. So you can see how that can get pretty expensive pretty quick. Yes, very expensive. So make sure that you understand that too. Some other notes. You've probably heard of what's called the 10% rule. Some investors look at that. They look at a property, it says it's $200,000. Does that hit the 10% rule? Well, 10% is 10% of the purchase price is what it makes every year. So if total rent for the year is $20,000, that could hit the 10% rule. You just simply divide that by 12, which your monthly rent would need to be about $1,650 to hit that rule. So if someone says, yeah, it applies the 10% rule. Some investors, their 10% rule is, I'm buying it for $200,000, it needs to rent for $2,000. The real rule is what the annual is. It's used different ways. But if you ever hear 10% rule, you can easily just think, okay, it's got to rent for 10% of the purchase price. It's really the annual amount, but a lot of folks just refer to it as the purchase price. This rule rarely works in our market because our home prices have increased faster than rent growth. Our prices change faster than what the rents change. Home values go up and down a lot quicker than what our rents do. Y'all notice that? If you need a good website to check to see if a deal works or not, dealcheck.com is a great website. It is free for up to I think 8 properties, but you can put in all the numbers, play with the numbers, and it'll tell you the rate of return, it'll tell you cash flow, it'll tell you everything. You just put in the property specifics. It's a really good site. Again, it's free to use. Where to find investment properties? Well, obviously the MLS. You can get foreclosure lists from the courthouse at that email. You just simply email them and they will send you a spreadsheet with a list of everything that's on the courthouse steps for foreclosure. Yep, and then you can see if you want to bid. There is a whole process for that. They also have what's called tax liens. Tax liens are, I didn't pay my property taxes this year. Well, the city and the county, they need that money, so they put a lien on the property, and then there are investors that pay those liens, and then eventually the investor can actually buy the property later. That's a whole other thing. But there's tax liens where it gets to the point where they sell those properties off. When they sell those properties off, they don't care about mortgages. They're only selling it for the lien amount. So the mortgage can be $150,000 still that's left on the mortgage, but the tax due is like 20 grand. They'll sell it for 20 grand. The mortgage goes away. Typically, got to get your attorney involved. That's typically how that works. So those can be very, very profitable. Every county is different. Substitute trustee lists. What a substitute trustee is if I'm a bank and I'm going to foreclose on a property, I'm not doing it myself. I'm not using my employees. I'm going to hire an attorney that's called a substitute trustee. they're going to do all the paperwork filing at that local county. They're going to make sure everything's done right, but they have a list of properties that they're processing in foreclosure. They have to let the homeowner know. They had to put public notices up. They got to get up to the county. There's a lot that has to be done. A lot of times you can go to the substitute trustee and get lists. They usually have them posted at the county courthouse. Sometimes you can work with them to get the property before it gets listed for sale. A great way to find properties is driving for dollars and seeing vacant homes and calling a homeowner. I'm telling you, that is an excellent, excellent way. Sometimes for sale by owners. Wholesalers are people that buy properties. They do the same thing. They're doing driving for dollars. They're knocking on doors. They're doing tax record searches to find people that own homes or have very little owed on the home. And they get into a deal and say, I'll buy your property for $40,000 or $50,000. So they get under contract with the seller to buy the property. And then they go and they try to sell it for $80,000 or $100,000. They're trying to wholesale it. They're making money. They have a contract to buy for 50. They sell it to you for 80, so they make 30 grand, and they don't do anything. That's what a wholesaler does. Some websites, auction, be very, very wary of wholesalers. They normally inflate the ARV, right? After repair value, they normally inflate that quite a bit, and they always inflate rent rate, how much it's going to cost or how much the house will rent for. Those are always inflated.